Hello, everyone. Welcome back to High Dividend Explorer. Today, we're diving into two popular high-yield ETFs that many income investors have been eyeing, J.E.P.I. and G.P.I.X. These funds share a similar goal, to provide high monthly income through dividends and options, but they go about it in unique ways. If you've ever wondered which of these ETFs is best to hold for long-term income, you'll want to stick around. By the end of this video, you'll know the ins and outs of J.E.P.I. and G.P.I.X., including their performance, dividends, and how they stack up against the broader market. This info is crucial for building a steady income portfolio, so don't miss it. And hey, if you're interested in more breakdowns like this, don't forget to hit that like button. Subscribe to High Dividend Explorer and join our community of investors chasing financial freedom through dividends. Comment below with your thoughts on these ETFs and which one you'd pick. Let's jump right into it, starting with an overview of each ETF. First up, J.E.P.I., or the J.P. Morgan Equity Premium Income ETF. J.E.P.I. is built to deliver monthly income by investing in high-quality stocks from the S&P 500. It then generates extra yield through call options on these stocks. This approach means it's designed to prioritize income, even though it sacrifices some potential for large growth gains. J.E.P.I. has an expense ratio of 0.35%. To put it into perspective, for every $10,000 invested, you're paying around $35 a year in fees. This is fairly reasonable, considering the regular monthly income J.E.P.I. aims to provide. J.E.P.I. primarily holds blue-chip stocks, such as large U.S. companies, focusing on stability over high growth. As of now, J.E.P.I. has around $30 billion in assets under management, showing its popularity among income-focused investors. J.E.P.I. has a current rolling 12-month dividend yield of 7.55%. With monthly distributions, it's almost like getting a paycheck from your investment, which is a big draw for income seekers. Now let's take a look at G.P.I.X., or the Goldman Sachs Equity Premium Income Fund. G.P.I.X. follows a similar path to J.E.P.I., aiming to provide high monthly income by investing in S&P 500 stocks and using call options to enhance yield. However, G.P.I.X. has some subtle differences that set it apart. G.P.I.X's expense ratio is 0.45%. On a $10,000 investment, that's about $45 per year, a little higher than J.E.P.I., but still manageable given the fund's focus on high yield. Like J.E.P.I., G.P.I.X. invests in large-cap U.S. companies from the S&P 500, which provides a stable foundation for the monthly payouts. G.P.I.X. is newer, with around $500 million in AUM, so it hasn't reached J.E.P.I.'s scale yet. Still, it's attracting attention quickly because of its high yield. Currently, G.P.I.X. offers a rolling 12-month dividend yield of 7.90%. Again, this is paid out monthly, offering the potential for steady income for investors. Before we get into performance, let's clarify how these ETFs work relative to the market. Both J.E.P.I. and G.P.I.X. rely on covered calls. In a rising market, this means they often underperform a typical S&P 500 ETF, like VOOO, because they cap some of their upside to provide steady income. But during market dips, this option strategy can offer more stability by bringing in extra income that offsets declines. All right, now for the part everyone's been waiting for, performance comparison. Let's look at how $10,000 invested in each fund would have grown from October 27, 2023 to November 11, 2024. Let's start with J.E.P.I. Starting at $10,000, J.E.P.I. grew to $12,652.39 with dividends reinvested, a total return of 26.52% and an average annual return of 25.28%. Meanwhile, G.P.I.X. took that same $10,000 investment and grew it to $14,029.04, a total return of 40.30% and an average annual return of 38.31%. Without dividends reinvested, J.E.P.I. achieved a total return of 25.56%, while G.P.I.X. earned 38.92%. As we can see, G.P.I.X. outperformed J.E.P.I. over this period, but it's essential to remember that past performance doesn't guarantee future results, and both funds serve income-oriented investors in similar ways. Let's also compare each fund to the S&P 500 ETF, VOO. Since VOO doesn't use covered calls, it keeps the full upside of the market and has had stronger growth over the long term. But keep in mind, JEPI and GPIX aren't trying to outpace the market. They're designed to provide reliable income instead. Here's how they compare to VOO. With dividends reinvested, JEPI grew 77.07% versus VOO's 117.77% since 2020, while GPIX grew 40.30% versus VOO's 47.94% in just over a year. Without dividends reinvested, JEPI reached 63.95% growth, while VOO delivered 113.05% over the same period. This highlights that while VOO offers more potential for long-term growth, JEPI and GPIX provide income, which is the main focus for investors looking for regular, high-yield distributions. To wrap things up, both JEPI and GPIX are solid choices for investors who prioritize income over growth. They're best suited for those who want to generate a steady cash flow without relying on selling shares in the future. However, as with any investment, there's risk involved. Talk to a financial professional to see if these funds fit your portfolio. Always remember, investing is personal, and anyone who says there's only one right way is either misinformed or has a hidden agenda. The most important thing is knowing your goals and choosing investments that align with them. Finally, if you enjoyed this breakdown, please like and subscribe for more videos on high dividends and income investing. Thanks for watching, and as always, stay informed, stay invested, and keep exploring those dividends.